Hey everybody, Marty Mazzora here. It's Friday the 12th of January 2024 with your weekly economic update. So we're going to do the usual, look at our score and a few of our inputs. Going to spend some time on inflation. Today, the CPI read came out Thursday for December, and producer price index, the PPI, came out today. So we'll touch on those. We'll touch on consumer debt, and we'll take a look at a number of commentaries from various companies. In front of you is our simple graph, and as you can see, our general conditions index is rolling back over negative 32, down 4 points week over week. That suggests that recession odds are still too high for comfort going forward. Jumping right into the December inflation data, the headline number, which X's out food and energy, jumped 0.3% year over year to 3.4%. The monthly took a pretty big move, up 0.3%. Both of those were a bit higher than expected. Core settled in at 3.9%. That X's out food and energy, up 0.3% on a month-over-month basis. So that's a bit concerning on a month-on-month basis to see 0.3 when Fed funds futures and a lot of people, and I think Fed members themselves, are counting on a continued deceleration in the inflation rate. One of our research partners' own forward-looking inflation indicators are actually beginning to bottom. And per this graph here from T.S. Lombard, sometimes there is indeed a second wave of inflation. Here, as you can see, in the 1940s, the 1940s is actually analogous to the current in terms of the size of the U.S. debt relative to GDP, deficit spending that's going to need to happen going forward, and so forth. But you can see how inflation, ramped up, came down, and then ramped back up and was very, very volatile. Of course, we're familiar with the 70s, inflation ramping up, calming down, and within 36 months or so, back up to the races, and then the early 80s and Paul Volcker and that story that we've explored here numerous times. So here we are in the 2020s episode, threatening some upside there. So again, there are some indicators that suggest that maybe there is another wave of inflation on the horizon that would fly hugely in the face of the bullish narratives that are out there for this year, that we have this immaculate soft landing where inflation gets down durably to the 2% target and so on. Actually, our base case is during the course of this year, while we may see inflation begin to threaten again, ultimately we do think it comes down and probably penetrates that 2% target. The durability of it, though, is a camp that we're not in terms of the belief that it's sustainable. We think that once we work our way out of whatever's left in the cycle, if indeed there's a recession on the horizon, that inflation comes back and settles in at a level above 2%. And if you recall our 1940s analog to today, it's actually necessary for the U.S. to actually see higher inflation than we've seen the last few decades. In fact, ideally, higher above the ultimate rate of yields, which creates a negative real yield environment. That's how the U.S. can get inflation back down below the level of GDP. And that is a very bullish thesis for gold on a long-term basis. And I'm going to talk about gold here at the end of this presentation. In terms of producer prices, now we're down for 3 straight months. So we had actually a 1/10 drop this month, as you can see over here, looking at my arrow. The estimate was for an increase of 1/10, so that came in favorably. The core on a year-over-year basis was up 1.8%. So clearly, producer prices are coming in below the Fed's 2% overall inflation target. And again, that's consistent with our overall thesis about the economy going forward. Consumer debt, that data came out, I believe it was today. Massive jump in terms of month on month, a jump of $23.75 billion. A lot of that was credit card debt. You can see that that's well over $1 trillion. So a lot of people are screaming about this number being over $1 trillion for the first time. I do think we need to put it in its proper context. As a percentage of household net worth, it is not historically a problem. And that's what the bulls like to rest their case on, is that, the consumers, yes, is spending more in terms of revolving debt, but their balance sheet still looks really, really good, and their debt service is not at precarious levels at this point. I don't disagree with that because it's true at the moment. The problem I have with the debt to net worth argument is that if we do see recession and we do see asset decline in value like we would, well, then suddenly that debt that's still there amid declining valuations becomes somewhat problematic. Small business sentiment came out this week. Actually, for the most part, I would say this is net positive. You can see that overall optimism ticked up a little bit here. Now it's still at low levels. It's at 91.9. Long-term average is 98. So it's nothing, to write home about necessarily. Look at capital expenditure plans. They've improved here month on month as well. So companies' expectations about investing back into themselves. Hiring plans, however, did take a notch down, and they continue to roll over. The chief economist for the NFIB does not sound very optimistic. Quote, small business owners remain very pessimistic about economic prospects this year. Inflation and labor quality have consistently been a complication for small business owners, and they are not convinced that it will get better in 2024. So again, notwithstanding the pickup in sentiment, the read of their chief economist is that there wasn't enough there to get optimistic about just yet. And then I wanted to just quickly run through the sector to S&P 500 ratio analysis. This is just a 1 month look back, and this speaks to expectations coming from the equity market and investors or traders in the equity market. So the first one is the tech sector relative to the S&P over the last month. So above 100 means it's outperforming. Below 100 means it's underperforming. So tech underperforming the broader average. Financials notably underperforming the broader average over the last couple of weeks anyway. Consumer discretionary stocks, okay? You talk about spending and so forth and how consumers are holding up the economy. Well, consumer discretionary stocks have been rolling over quite notably, certainly relative to the index, or I should say they're underperforming the rest of the index. Material stocks, similar look there. Again, economically sensitive stuff. Energy stocks. A lot going on in the energy space with geopolitics and so forth, as you can imagine, but there's the look right now. Industrial stocks, right? Grossly underperforming the S&P of late. So those are your economically sensitive sectors. How about consumer staples? Things you buy when you want to stay alive, right? So you can see they've been picking up a bit here relative to the S&P, virtually a tie. Utility stocks, very defensive, still grossly underperforming. Very interesting setup right here for utility stocks. We don't own them directly, but they are on our radar, particularly in a recessionary environment. And then healthcare, obviously defensive sector, right? This is healthcare stocks as well as staples and utilities tend to outperform your more cyclical stocks in a weak economy. You can see healthcare is the one sector that's notably outperforming the S&P over the last month. So that score has gone from neutral to negative in our indicator, meaning we take all of this into account, and then we have one component, which is our sectors to S&P 500 ratio, and it went down a notch. So now we'll take a look at another economic indicator, which is pretty popular in some circles, at least conceptually. It makes some sense. It's not perfect, of course nothing is, but it is interesting to chart the gold-copper ratio. It will rise, meaning gold outperforming copper, typically at times when there's concerns over the economy, right? Gold being a somewhat defensive commodity or currency or asset class. Copper being very economically sensitive. Some call it Dr. Copper. That's the nickname because it, as they say, has a PhD in economics. Obviously, when the global economy is good, there's a lot of building, there's a lot of investment, and copper does pretty well. In fact, we're quite bullish on copper on a long-term basis and not in a small way because of the whole green energy transition. But just kind of take a look at the copper-gold ratio, leading into recessions, here before the tech bubble recession, here before the real estate and mortgage bubble recession, and here before the COVID recession. Remember, as I said in the video yesterday that I think was sent to you this morning, clients, the Fed was trying to tell us that everything was okay in here, and you can see that the copper gold ratio was consistent with our own analysis and the scoring of our own index, saying that recession risk was rising. But it doesn't always signal recession, right? Here it was leading into 2016, rising, no recession, jumping up big time here in 2011, no recession there, and then a pop in here that was soon followed by a recession. I threw in the S&P 500 down below too, because even in these times where a big move in the gold copper ratio, it was reflecting perhaps concerns about the overall economy. So right in here, this culminated in a 10% correction in stocks. This was during the European debt crisis, and make no mistake, there was a lot of angst about the global economy in the US for certain, and a 20% drop in the S&P right around that time. So as we were rising in here, 2015, 16, 15% correction, 16% correction respectively. It started to come up in here. We had that 20% correction in the fourth quarter of 2018, and it was ramping up big time before the recession that got stick-saved due to all the money in response to COVID. So folks, here's the point here. You can see it was ramping up here. We had our bear market, we think the first leg of the bear market in 2022. And so this is a warning sign to roll into recession. And if it does, you can see what may happen to stocks, hence our hedging right now and being very diversified and having a significant portion in a short-term treasury money market fund. Good thing it's still earning north of 5%. So it's not like we're sitting on idle cash, but this is just one other kind of macro data point that says that it is prudent to have some defense in your portfolio right here. And then speaking of gold, you may recall I mentioned that since gold was a not small position in our portfolio, look at the daily chart here first, we actually, literally right here, we bought some put options on our gold position. They literally doubled the next day. We were able to roll them, collect all of our premium back, and stay hedged. And we rolled it again for about another 30 or 40% move on that hedge. And then we let the rest of it just expire. So that was not only free insurance, we actually made some money on the options. And we were able to keep our gold position, which we want to keep long term. Well, today, folks, we bought some protection, 5% out of the money, so we can't lose more than 5% on our gold position between now and March 1st. So the technicals are flashing some signals right here. I think the big jump that we had today, and you can see we came down off of that, but it was up well over 2%, I think, at one point today, or it was close to it. That was in response to military action from the US and the UK last evening. And so we took that opportunity to go ahead and continue to hedge. It was very cheap, so we feel good about that. Our short-term thesis is concerning for gold. A lot of people, the gold enthusiasts, are saying this was going to be a breakout and significantly into new all-time highs. We actually think we will get there in the not-too-distant future, but we figured that could very easily be a failed breakout, and those aren't good, and that's what it is so far. And this is a retest of that level. So, folks, I think you do want to own gold long-term right here for a variety of reasons. I do think short-term, if you own it, just prepare yourselves for some potential downdraft. I have the copper chart here as well, speaking of copper and gold. So remember, we looked at this right back in here, and I said this is a bullish pattern. I said that down in here, and sure enough, we got a pretty good pop in copper. It's coming off the boil a little bit, hitting its 50-day moving average. It's going to be interesting to see. We expect maybe some news over the weekend from China that could be somewhat favorable for copper. We'll see. We think more stimulus is going to come to bear. Not everybody thinks that. One of our research partners, who is an expert in emerging markets, is very bearish on China's prospects going forward. Nevertheless, China has some, I think, ambitious economic goals this year, but they do not want to blow up further the property bubble that they have. So that's problematic. China's got some structural issues. I'm not necessarily a long-term bull on China. It would not surprise me to see Chinese equities do well this year, largely because that is not the consensus view. So something positive changes there in China, we could see quite the rush to Chinese equities. In the charts, they're looking interesting right here. So anyway, not something that we're focusing on specifically or directly in our core portfolio necessarily, but interesting to keep an eye on it. And the better the Chinese economy does, typically the better copper does as well. Okay, so I mentioned that I wanted to share with you, and I'm just going to read from some notes here on what companies have been suggesting this week. On the plus side, starting with KB Homes, as our new fiscal year gets underway, market conditions are improving, with rates having declined and consumer confidence increasing, all while resale inventory remains low. As interest rates have now declined since the end of our fiscal year, demand has improved significantly. Our orders in December were higher than November, which is unusual given that December is typically a slower sales month. To us, this speaks to pent-up demand for home ownership. So that's the positive from KB Homes commentary. And here's the not so positive. In the fourth quarter, our overall average selling price of homes decreased to approximately $487,000 due to both mix shifts and the impact of pricing adjustments and other homebuyer concessions, such as mortgage rate locks and buydowns. And their gross margins fell to 20.8% from 23.9%, quote, mainly due to price decreases and other homebuyer concessions, along with higher construction costs. So, yeah, clearly it's not all roses when they have to offer such concessions that are showing up in their revenue numbers and so on. But again, certainly nothing dire when you take both sides of their commentary today. Delta Airlines in 2024, demand for air travel remains strong, and our customer base is in a healthy financial position with travel a top priority. WD-40, we are encouraged that the improvement in trends we experienced in the second half of fiscal year 2023 have carried into fiscal year 2024. This is the first time since 2021 that our business has been firing on all cylinders. We saw volume-related sales growth this quarter in all three trade blocks. So nothing wrong with conditions for WD-40. On the flip side, from Neiman Marcus's CEO, when we look at our performance in the holiday, we are in the luxury market, and that market is experiencing a slowdown. And it's also a market that is promotional, specifically online. We experienced low single-digit negatives compared to the prior years, but which is still up when compared to 2019. Burberry. We experienced a further decline in our key December trading period, and we now expect our full-year results to be below our previous guidance. Microchip, the weakening economic environment that our customers and distributors faced during December 2023 quarter resulted in many of them wanting to receive a lower level of shipments as they took actions to further de-risk their inventory positions. Many customers had also extended shutdowns or closures at the end of the December quarter as they managed their operational activities. The impact of these and related factors was that certain backlog that we had planned to ship when we provided our guidance on November 2nd did not ship to customers before the end of the December quarter. As a result, our preliminary revenue indication for the December 23 quarter is to be down sequentially about 22% compared to our guidance of down 15 to 20%, which we provided on November 2nd. From Extreme Networks, our revised fiscal quarter outlook reflects industry headwinds of channel digestion and elongated sales cycle. In late Q2, we saw multiple large deals pushing out to further quarters. From Delta, our March quarter faces headwinds from three dynamics when compared to last year: higher international mix, the normalization of travel credit utilization, and lapping a competitor's operational challenges. From MSC Industrial, on our last call, which was midway through October, we described sequential softening of demand that began in September. The causes included reduced spending due to sustained high interest rates, the ripple effects of the UAW strikes, inventory burn down, and overall caution among our customer base. Following our call, we experienced an even softer back half of October, resulting in another sequential step down in our growth rate. And there's more to that one. I'll move forward. The Container Store. The challenging business trends we experienced in the second quarter continued. General merchandise categories underperformed compared to our expectations and were relatively consistent with our second quarter performance. That's plenty. So thanks to Peter Bookfar. He does a wonderful job for us and for the rest of his clients or subscribers, breaking down the key commentary, both good and bad, very objectively from the companies as they report it. So as you just heard, there seems to be quite the abundance of concerning commentary coming out of companies. It's going to be a very interesting earnings season, which is just now getting underway. This is important to hear. It's going to be the forward guidance that, of course, moves the needle on stock prices during earnings season. So, folks, probably a long one after I edit it. Thank you. I appreciate it for watching and listening. And I think in summary, like last year, we can make money in this environment, but I do think we have to have an eye on mitigating the downside and a strategy to do that as well. Have a great weekend. Thanks again. Bye-bye.